Uh, Good afternoon to everyone. Welcome to our webinar discussion on open banking in Qatar, prospects and potential. This seminar is made possible by NPRP Project Award on Regulation of FinTech in Qatar, funded by Qatar National Research Fund, member of Qatar Foundation. My name is Otabek Ismailov, and I'm a postdoctoral fellow at College of Law, Center for Law and Development at Qatar University. Today, as part of our grant project, we are holding a seminar discussion on open banking in Qatar. I hope everyone has received the resource material sent as an attachment to the invitation email. As you may know, there have also been significant open banking related regulatory developments in 2020 and 2021 in many Arab countries, namely in Saudi Arabia, the United Arab Emirates. This also follows the Central Bank of Bahrain's launch of its open banking framework in 2018. Thus, we found it timely and appropriate to hold a seminar discussion on this topic from the state of Qatar's perspective. The aim of this discussion is to gain insights into how we might collectively pursue an open banking agenda in Qatar. We invited very distinguished speakers. Professor Doug Arner, he's one of the world leading experts on financial regulation, particularly the intersection between law, finance, and technology. He's the Kerry Holdings Professor in Law and Director of the Asian Institute of International Financial Law at the University of Hong Kong, where he serves also as a director of several LLM programs. The second speaker is Professor Ross Buckley. He's a Cynthia Professor at the Faculty of Law at the University of New South Wales, Australia. His areas of expertise are fintech, regtech, blockchain technology, cryptocurrencies, and central bank digital currencies, initial coin offerings. And Dr. Andrew Dagdal from Qatar University. He's an assistant professor at College of Law, Qatar University, and the head of a section on economic diversification at the Center of Law and Development. His areas of expertise are financial regulation, fintech regulation, and commercial law. So each speaker will be given from 10 to 15 minutes to present their topic. After all presentations, we will have a Q&A for about 15 minutes. You can send me your questions or comments through the chat box in advance so that I could put them in sequence. So the first, I'm giving the floor to Dr. Andrew Dagdal from Qatar University, who will speak about the concept of open banking, how it works in practice, its advantages and risks. Dr. Dagdal, the floor is yours. Welcome, please.
Thank you. Thank you, and thanks to everyone for attending. Hopefully this seminar will be useful and eye-opening to a lot of people. It comes to me to set the scene and to define what open banking is and what it is not. So the term open banking from the start, I think, elicits a lot of discomfort and misconceptions from a lot of people, and maybe that's why there's a reluctance among conservative regulators to embrace it. It's important to distinguish that when we're talking about open banking, we're not talking about banking deregulation. It doesn't necessarily mean anyone can be a bank and the banking sector is open. It's something different altogether. The idea of operating in a banking environment will always require a banking license. In nearly all jurisdictions where banking takes place, licensing regimes exist and they will continue to exist. There may very well be different classes of banking licenses for different operators, but the idea that open banking is somehow opening up the gates of banking to anyone to set up shop is not entirely accurate. As part of my doctoral dissertation, I actually looked at periods in history where there was a so-called free banking regime. For example, the second half of the 19th century in Australia, there was a free banking movement where kind of anyone could set up a bank. It was surprisingly stable, actually. There wasn't that terrible, but it did lack a centralized point of control. And in the modern financial milieu, central points of financial control are vitally important for macroeconomic stability, and also at the micro level, making sure customers are not taken advantage of with inequalities in bargaining power. What we are talking about with open banking is opening up the data stores of banks, or opening up data. And so open banking is an expression that is much broader than just banking. And as maybe Ross will discuss later on, it doesn't necessarily only have to apply to banks. But in the modern context, when we're looking at financial technology as really gaining momentum, or having gained momentum and becoming the new normal, starting the discussion with open banking and opening up data from banks and financial institutions is, I think, a good starting point. I'd encourage everyone to look up the Monetary Authority of Singapore's API Open Banking Periodic Table. This was, I think, published around 2018-19, and it is a table which catalogs close to maybe 200 points of data interaction between banks, financial institutions, and customers. Everything from marketing to lending to transacting on accounts is included in this periodic table. So this is a very nuanced area, and a broad area where many different types of information and data exist and can be shared. So when we talk about open banking, we really need to take it slowly and be very specific with what type of data are we talking about sharing, who is sharing it, and with whom are they sharing it. And within that kind of relationship, there are moving parts for regulators. Cybersecurity will always be an issue when data is being shared, as will data privacy. All of these factors need to be considered when we're looking at regulating an open banking regime. At the heart of this will always be the consent of a consumer. The philosophy that kind of overarches this area is one of consumer data primacy. And you see this with pieces of legislation and regulatory frameworks across Europe with GDPR and PSD2, the consumer data right in Australia, and even things like the CCPA in California. They're all geared towards customers having control of their data. So consent will always be at the heart of this. And for regulators, the thinking then has to be what is informed consent, what are the modes of consent, what type of, how long will consent last, and all these kinds of things. But that's getting into kind of the nitty gritty of it. Let's keep the discussion a little bit broader at the moment. What's in it for banks? Why would banks share their data if they don't have to? And that raises the question of, should this process be market driven or should it be regulation driven? If this was so lucrative for banks and sharing data was lucrative for banks, then they would have done it already. But as you know, some of the attendees at this seminar will tell you, dealing with banks when you're a small startup is not the easiest thing. And banks might sometimes be quite territorial about the data that they have. So looking at a regulation approach might be necessary in order to coax banks or encourage banks to share their data. Well, what's in it for banks? It's a problem of scale. When banks have many customers, they'll find it extremely difficult to supply or give personalized services to customers. And so when you have third parties who can use that data and personalize a banking service for customers, the banks are leveraging the efforts of that third party in order to better serve their customers. And when we're talking about data as being a source of service, you have to talk about the big tech companies. And increasingly, the big tech companies are coming into the financial space. And this may also be seen as quite scary for banks. If they have to compete on the playing field of data, then Google's going to crush them because they have all the data. So banks need to acknowledge that there could be an element of reciprocity in the sharing of data. If they share data with these big tech companies, I think in the Australian regime, it was discussed, I'm not sure if it was implemented, that banks who share data with a third party also have an entitlement to get data from a third party. And that will allow banks and financial institutions to even better serve their customers. This area of finance, a good expression I heard referred to it is modular finance. So when you think of this, think of like IKEA. You can buy the base set of a product and add to it, and things fit and they go together. In this situation, a bank account would be the core product that you have, and with a open banking system, third parties could plug into that particular bank account and provide additional ancillary services. And how well your base product fits with those ancillary products will create value for your customers. I remember in 2013 in Australia, there was early days of financial technology. There was an app called Pocketbook, and it worked with one particular bank, and my friend showed it to me and it was fantastic. And I wanted to use it. It was a budgeting app which showed you a breakdown of where your spending was and things like that. But the graphics were amazing, great logos and things. The granular information was fantastic. I was very close to changing banks from my incumbent bank to this new bank just for the purpose of using this new fantastic app called Pocketbook. I recently looked it up again just a couple of weeks ago, and it's doing very well in Australia, and it's pretty much integrated with all banks in Australia. So for Qatar, who has shown quite reluctance in the more exotic areas of financial technology of, let's say, crypto assets and cryptocurrencies, I think open banking is an area where it can help develop the ecosystem, the regulatory ecosystem in Qatar, without going into those areas where regulators get nervous and they're a little bit unknown, and other financial centers in the Middle East like Dubai and Abu Dhabi are focusing on kind of crypto asset markets. So for Qatar, this is really close to core infrastructure that you need for fintech development in your country. This is not kind of a new experimental type of framework. This is fastly becoming the new norm and the expected data sharing protocol required for your jurisdiction. By its nature, again, open banking is a process that can be phased in slowly. You can, if you look at the resource that we developed, there is a proposed phase-in period for the sharing of data by incumbents in Qatar. And the nature of the data that can be shared can be anything from publicly available existing data like ATM locations and bank opening times and branch opening times and things, all the way to the more extreme kind of personal information about the transactions and transaction initiation. So it's not an area that we can readily quantify the benefit of open banking. Rather, the benefit comes from the unknown innovations that can stem from an open banking framework. And on that point, I'll end and I'll hand over to Professor Anna.
Thank you very much. Thank you very much, Dr. Andrew. It was quite informative presentation, and I'm giving the floor to Professor Arner. So he will speak about open banking frameworks internationally. Welcome, please, Professor Arner.
Yeah, thanks, Audebek, and thanks, Andrew. I think Andrew's highlighted a lot of the key sorts of issues, and I want to go at this from a sort of big picture standpoint. In other words, why would we be interested in this area of open banking, and particularly enabling access to data and finance? And I think we can look at this really from a number of different angles. One angle is from the standpoint of digitization of finance. In other words, we've seen a long-term process of digitization of finance, but we want to encourage more innovation, new business models, new approaches. How can we enable new entrants to come in? The second is about fundamental approaches to data. In other words, how can we leverage the benefits of data from a wider societal development standpoint? And third, how can we try to address some of the risks which we're seeing evolving around data? And I've got a set of slides that I'll happily pass over to Andrew to distribute to anyone that wants them. But I think a couple of pieces are useful out of this. And the first is kind of how we got there. And I think if we're looking at how we got there, much of this evolves in the context, particularly of the EU. We can kind of see it evolving from three different directions. The first is really around the digitization of data in financial services generally. And this is something that lots of jurisdictions around the world are increasingly focusing on digital regulatory reporting. How can you require financial institutions to meet regulatory reporting requirements in a digital fashion? This is good from the standpoint of efficiency in the financial services sector. It's also effective from the standpoint of addressing risks and supporting wider development. But of course, requiring digital disclosure of information by financial institutions requires those financial institutions to digitize and structure their data on clients. And in the EU, this received a tremendous increase in 2018 with the implementation of something called the Markets in Financial Instruments Directive 2. And we're seeing this increasing in jurisdictions around the world. That's one strand. A second strand has really been around data protection. I think it's important that when we think about data protection, we realize that different societies are approaching this issue in different ways. And so this little box kind of highlights in the big three economies, different approaches to data in the private sector, the market-based area, as well as in the government and state area. And if you look at the EU, and we often focus on the EU's data protection framework because it's something that has been exported all over the world on one side. Lots of countries all over the world have frameworks that are based in particular on the EU's various privacy and data protection directives. But secondly, the EU's most recent data protection framework, GDPR, the General Data Protection Regulation, is extraterritorial in scope, which means that whoever you are, if you're dealing with data of EU citizens, the rules, the requirements, and the enforcement mechanisms of that directive apply to you. And if we think about that directive, why has it been put in place? And it really has to do with two different processes in the EU. The first is a strong cultural preference towards protection of personal data. And it essentially takes a rights-based approach to data, which basically says that many aspects of personal data are always the right of the individual around who that data is created. The individual can allow that data to be used, but at the end of the day, it's always there. So one is a sort of strong cultural preference. The other is essentially a reaction to the US property-based approach to data, which has allowed the development of large platform companies on the basis of essentially freely transferred data from billions of customers all over the world, and a fear that the use of those large data pools would give the US companies an unfair advantage in EU markets. And so a decision both for cultural reasons to take a different approach to data protection, but also from the standpoint of competitiveness. And I think this is important, that if we think of this evolution in the EU, reporting really about financial development, financial regulation, financial stability, data protection, both for cultural reasons, but also for competitiveness reasons. The open banking requirements in the EU are in what is called the Payment Services Directive 2. And this really has a genesis in trying to break the dominance of large banks on cross-border payments in the EU, and essentially a decision to make those banks share data in order to allow new entrants, new competitors to bring down the costs of cross-border transfers. At the same time, looking forward, one also thought about, if we can open up bank data, that will then support innovation and competitiveness more generally. So what I'm saying here is, when we are thinking about use of data in the financial system, we're actually thinking about it from a number of different angles. How can that data be used to support the better functioning of the financial system? How can that data be better used to reduce risks in the financial system? And importantly, how can data be used to support innovation and development and competitiveness? Now, what this box shows is that from a competition standpoint, there's a big issue. And that is, if we think about data use, if we think about things like artificial intelligence, there are network effects in data. The more data you have, the more advantage you have from a business or competitiveness standpoint. From the standpoint of training AI, the greater the volume of data you have, the better you will be able to develop those systems. And that has an important competitiveness benefit. And it's no, if you will, coincidence that the US and China, which both have models which allow large-scale private amalgamations of data, also have some of the most developed and competitive AI systems and data use markets. So that's one side. How do you go about getting the benefits of data aggregation? And a simple way is just to let private companies take on that data in a market-based framework. But of course, the risk is that you already have a number of large data companies, particularly out of the US and China, and those companies are already going to have an inherent advantage over just about any other jurisdiction. And so how can then you think about competing with those companies? The second, however, is that data concentrations, in addition to their benefits, also bring risks. And this is something that likewise we're seeing from the standpoint of both the US and China. Think about it from the standpoint of, what do network effects mean? They're economies of scope and scale. That means that there is a tendency towards concentration and market dominance. We often say in tech that there is a tendency towards winner takes all outcomes. What is a winner takes all outcome? That is an outcome where everybody else loses because one company has built an ecosystem that dominates all aspects of data. And certainly China decided last year that that was a pretty good description of what its economy looked like. A small number of private data companies which effectively dominated access to all data throughout the economy, and that brought with it not only risks of concentration and dominance to wider innovation and development, but also financial stability risks, because these had emerged as new systemically important financial institutions. So, where am I going with this? I'm going at this that when one thinks about data in finance, one needs to think about this as a country strategically. How are you going to try to get the benefits of data while at the same time trying to balance some of the risks in terms of concentration? And if we think about the EU's model around data protection rights and open banking, which in the new 2020 EU digital finance strategy is expanding to open finance, which means a sharing requirement across any financial sector participant. That's really important because from the EU's standpoint, they're trying to figure out how to provide a mechanism whereby new entrants can get access to data without resulting in single companies or firms dominating those markets. The US is struggling with this, but its model of a property-based structure has emerged in globally competitive data companies, but that's a challenge for everyone else. China has now realized that there are risks in this property-based approach and is now looking at a different approach. Break them up, perhaps, take an EU-based approach, or actually take away the data and create a public pool of data, which is then accessible to a wider range of players. But of course, these are big, big markets with lots and lots of data. If you're a small market, you don't have very much data, and that data is maybe going to be useful from the standpoint of improving your own financial sector, but it's unlikely to be sufficient to actually make your domestic institutions able to compete with the mass scale of data pools elsewhere. So what do? Well, you need to think about, as an international financial center, what do you need? Well, you need the ability to bring in data flows from elsewhere. And essentially what that requires is a system whereby you provide a clear set of protections, either property-based or rights-based, around use of data, which can then serve as a mechanism of trust to other jurisdictions. It also provides a mechanism from the financial stability standpoint so that you will be able to use that data. And from the standpoint of your own domestic financial system, thinking about enabling access to data across that financial system. Why? Because, as Andrew has highlighted, individual financial institutions will not share, in most cases, voluntarily. And as a result, we see a range of processes, which are often called mandatory or legislative processes, like you see in the EU or the UK, or in the context of Australia, regulatory-led processes. These are processes where essentially the regulator, usually the central bank or the bank regulator, says you need to do this and begins building frameworks. And we see this sort of approach in Hong Kong and Singapore. And it can work to the extent that you have a relatively small market where the regulator has close interactions with the institutions. The last is what one might call an industry-led voluntary approach. And this is what you could say the US has. And most would say that in an industry-led voluntary approach, things move pretty slowly because the people who have already built large ecosystems don't have too much of an incentive to cooperate with the others. And so this is the sort of framework that we're developing. And I think my closing point is that from the standpoint of a country like Qatar, there's a need to think strategically from the standpoint of data in the economy and in the society, and how that relates to not only the financial center in Qatar, but also to financial sectors elsewhere. Thanks, Andrew.
Thank you very much, Professor Arner, for a very insightful presentation. Now I welcome Professor Ross Buckley. Professor Buckley will speak about the Australian experience with consumer data right regime, which is also considered Australian open banking standard. Welcome, Professor Ross Buckley, please.
Thank you, Artemek, and thank you, Andrew, for the invitation. It's good to be here. Yeah, the consumer data right is being rolled out right now as an open banking initiative. But the idea behind it, the reason it's called CDR, the consumer data right, is it puts consumers in charge of their own data. So what's really different, and I'm interested if anybody can tell me in the Q&A if anybody else is doing this, but what it strikes me is this is a quite extraordinary initiative in that the government doesn't intend it to begin and end with open banking at all. It intends it eventually to sweep right across the entire economy. So the first area where it's rolled out is open banking. At the moment, it's allegedly in place for the big four banks, but not all the other banks in the system. I say allegedly because it's slow getting out of the blocks for good reasons. But in time, it's going to be rolled out across the energy sector, then the telecoms sector. Those two are, the government has already committed to rolling out across those two, but also probably pensions, which we call superannuation, and insurance. And then beyond that, the rest of the economy. So the idea, excuse me, as I said, is that the consumer is in charge of their own data. And I think the best example is in energy. The potential of this to be transformative is in the energy sector. And actually, in an ideal world, I think Australia would have rolled it out in energy first, not banking, but they rolled it out in banking because everybody else is doing open banking, right? So it's understandable. But you'll understand when I take you through a sort of transaction why I think energy would be better. At the moment, I get lots of phone calls, once every 2 weeks. Somebody, sounds like they're in a different part of the world who wants me to switch energy suppliers. And I always say, thanks, but no thanks, and hang up because I'm too busy. And I sort of think that it's not going to be easy. I don't even know what I pay for my electricity. I mean, it's not going to be easy for me to look at what they're offering and try to work out whether it's the same or better or worse or whatever, and it doesn't matter enough to me, so I don't bother. What in energy, what CDR would mean is that rather than ringing me up and annoying me, there'd be a button on a website, or somebody would send me an email and they'd say, if you want us to prepare a detailed quotation based on your energy usage, press this button. I would press the button and they would come back and say, this is your current plan. This is what we propose. This is how much money you would save based on your energy usage over the last 12 months. So it would be sort of a legally binding offer. And that's called read access in the Australian regime. By pressing on the button, I'm empowering them to read my data. What's underway at the moment is the right access part, WRITE, which I prefer to call action initiation because I find right access a funny term. The action initiation piece, which isn't in place yet, but is being rolled out, would, if when I got the email back saying, this is what you're paying, this is what you could be paying, do you want us to do this? I'd only have to press on the next button on that. When I press on that, that initiates the action. And the first thing my current energy supplier finds out is they've lost me as a customer because the new energy supplier is initiating the transfer from them, from the old supplier to the new supplier. That's what's going to be really powerful, I think, because that's going to introduce what I like to call a sort of new commercial morality. At the moment in Australia, banks offer their current customers worse deals than their old customers. They prefer the new customers, and they know that a lot of people are sticky, so they don't offer them. If every time the RBA reduces interest rates, if you wanted the loan interest rates on your home loan to be reduced, you have to contact your bank and argue about it. They won't just ratchet them down. But for new customers, they'll always offer the lowest rate. Same with energy companies. Energy costs are very high in this country. they will offer new customers much lower, feed-in tariffs than they will the current customers. If we had that sort of CDR regime on energy, they wouldn't be able to play that game. The first they would know is about losing the customer is they've lost them. And that's why I think banking is not such a good basis to roll it out on, because it's not as easy switching banks as pressing a button. You've got to change the names on the accounts, you've got to change the credit cards, you've got to change this, you've got to change that, you've got to, it's complicated. So in banking, even if I find out somebody's offering me a better deal, I still have to go back to my current bank and arrange the transfer. And at that point, they will definitely offer me the better terms. Whereas something like energy, who provides the electricity that comes in over the wires, is very, very simple. So, but that's, I think, the real potential of it. The real potential is to make the suppliers accountable for what they're doing right now, because the consumer can, with the press of 2 buttons, the bit of information between them, just switch suppliers and can switch them that easily. So I think the potential is really dramatic, particularly in an economy like my own, which isn't characterised by much competition. The banks in Australia don't really compete with each other. We have 2 grocery stores, really. We have grocery stores own the liquor outlets, and own the hardware stores. There's very little competition. And so this is an attempt by the government to bring in a whole lot more competition. And I find that rather remarkable, that government is doing something as forward-thinking as this. So I think its potential is very large. I said earlier it's being rolled out slowly for good reason. The reason is the risks are very large. The first time a customer authorises one energy provider to quote on the provision of energy and they get 8 quotes from 8 different ones, they're going to be unhappy. And we saw that in Australia. The government tried to roll out something called My Health Record a couple of years ago, trying to get everybody to get their medical information held centrally, which is a very good idea, but they didn't implement it well. People weren't confident about the security of it, and it didn't work very well. So the lesson from My Health Record is you get one shot at this. If you botch it, people become very conservative and don't sort of participate. So, and there's also a lot of work having to go on behind the scenes. So there's a lot of standardization required. For it to work, the industry has to agree on standardized terms. Otherwise you can't do the comparison part. So that is all being done in banking. It's taking time, but it's happening. The banks initially had to be dragged kicking and screaming to it, but they're doing it. But in the sectors to come where it intends to be rolled out, for instance, telecoms, at the moment it's almost impossible to compare 2 mobile phone plans, right? If you've tried to do it, the rates per minute are very different, the number of minutes are very, very different, but when you exceed the cap, the rate shoots up very dramatically. On another one, it doesn't increase very dramatically. The first one is really making its money off not selling the time, but selling inflated rates for people who do exceed their cap, et cetera, et cetera. Those sorts of things have to be standardized for this to work. The classic in insurance is the definition of flood, right? There's no agreed national definition of flood, so different insurers mean different things. The insurance industry understands they're going to have to agree what a flood is. And it all has to do with whether the water's rising or falling, you believe. Whether it comes, the issue is often the industry will try to avoid liability for a flood because they'll say it was a storm. They're going to have to resolve all that stuff to make the CDR regime work when it is applied to insurance. But at least at the moment, the government is fired up about this and is working very hard to make it happen. And recently, initially, the relevant regulator was the ACCC, the Consumer and Competition Commission. They are still the enforcer of rules, but they were given the job of driving this initially. That was almost certainly a mistake. There's a bunch of lawyers, and lawyers should never be put in charge of achieving anything. So the government's pulled it away from the policy part of it away from the ACCC and given it to Treasury. So that's a real sign. Treasury is, of course, the most powerful department in Canberra. and they're used to driving things, and that's sort of an example of the degree of government control. So unless we have a change of government, we're going to see a lot more of this. I think it's going to continue to roll out. It's going to take a long time, but I think it's going to really be transformative. And somebody mentioned reciprocity before. Yes, as I understand it, what Australia did is it required reciprocity. So if Google or Facebook or somebody moves into financial services and wants to play in this space, they have to make all their data available. So that's the sort of attempt to stop the big players sort of swamping the market, because of course they have much more to give than they have to get. So I will finish on that note, and I think we move on to questions. Otterbeck, you're on mute.
Okay. Thank you very much, Professor Buckley, for your very informative presentation. Now we move to Q&A section. I would ask the participants to ask their questions if they have, or any comments related to today's presentation, please.
Hello.
Yeah.
Yeah, Michael.
Yes, Mr. Michael.
Thank you for the presentation. I think I pretty much met some of the gentlemen that is presenting. My question is, I'm just a quick intro. So I'm the CEO and founder of C-Wallet. So we're a fintech startup that is promoting two different services: our own payment gateway and a mobile money wallet that is pretty much similar to mobile money wallets that most expats in Qatar are accustomed with. And now with the demand of open banking, etc., so there's a high potentials for us to actually succeed and get regulated. Especially, we just submitted our compliance to central bank today. Now the question is a small country like Qatar a good market for open banking? Because based on my experience, like for wallets, it is actually working well on highly populated markets where the unbanked population is high. And in Qatar, the wage protection system is allowing migrant workers to have a dummy bank account, but they're not getting the services that they are wanted to have, like microloans, finance, etc., even access to e-commerce. Because the dummy payroll card they have is only limited for withdrawing cash. So I'm not sure if Doha would be accepting open banking. They're very hesitant compared to other regions. So is this a good market for open banking, and what are your thoughts about it?
Well, I might start off there. Being based in Qatar, maybe I can speak about that a little bit more. In terms of practically implementing it, I think it would be very easy in Qatar, because a lot of the data is centralized in the central bank. And the data stores are not so much so with customers. I mean, the reason it takes a while to transfer money from one bank account to another in Qatar is because everything has to go through the QPay system, the payment system in Qatar, and the central bank keeps a lot of information about all transfers and a lot of information. So practically implementing it, it would be easy. Whether there is a market demand for it, I think there definitely is. There are maybe zero, or I think there's one just starting comparison services in Qatar. I mean, for insurance, there's different segments of the insurance market: takaful or Islamic insurance. I mean, there are different subsections where there is a competition in those subsections, which will really benefit from comparative websites and open banking and data sharing. Moreover, Microsoft has recently established a cloud storage facility here in Qatar. So the idea of data sovereignty is being taken very seriously. So the data is physically being kept in Qatar, and that might allay some fears about sharing it as well. the fact that if you're accessing data that's stored in Qatar and you're a Qatari company and you've got all the safeguards in place, it shouldn't be that difficult. And catering to different markets, there are various expat markets, the largest one being the Indian market here in Qatar. They could also be better served with more personalized services from incumbent financial service providers here in Qatar. Should open banking be implemented and innovative entrepreneurial startups come in and meet that demand. So look, it's not just window dressing. I genuinely believe that open banking has a lot to offer the market, and once that value is realized, there will be more and more support for it to be expanded.
Related on that, and it's something that if I think about these sort of different competitive approaches in different places, I think actually to make an open banking system work, it requires a fair amount of development in a jurisdiction. You need to have something, the technology that enables the interaction. And in some ways, a small jurisdiction makes it easier to get those systems in place than a bigger market. And Qatar is both small as well as extremely well resourced. And that means that the constraints which might exist in, for instance, a Brazil in building something like this really don't exist. The question then is from the standpoint of a strategic approach, whether you have a decision that basically says in terms of future development, how are we going to maximize data? And at the very least, as a financial services center, you have to deal with interactions with other financial jurisdictions that have their own requirements about how data must be dealt with. And so I think that means that there's a need to have some sort of approach. Andrew actually, in mentioning the centralization of data, highlights that in some ways in Qatar, there may be the possibility of other structures. In other words, if, for instance, you already have a large publicly centralized pool of data, it may be possible to enable access to that by a wider population. And that seems to be the direction that we're seeing China moving into. However, I think in the context of a small jurisdiction, there's a lot to be said for building the infrastructure, enabling the sort of sharing, because once you have the infrastructure and enable the sharing, that should trigger a competitive process which should support innovative new approaches and business models.
Yes, conventionally, Michael, it's people like you who would be in favour of this, because certainly in Australia, it's the fintechs who are very keen to see open banking get rolled out a lot more, because at the moment, what they're suffering under relative to the major banks is a dearth of data. Right, open banking should give them access to a whole lot more data, and at the moment, the banks have a lot of it. The people who have the most of it are the banks and the major supermarket chains. To the extent people use frequent shopper cards, they know an awful lot about their customers, and fintechs don't. So it's a real attempt to sort of level that playing field, I think. Andrew, you were going to?
Yeah, I was going to say, Michael and I, we've discussed the role of fintechs in the Qatari market previously. And I think this process will have to be led on a technical level by the expertise coming from those fintechs, in particular with the adoption of a standard protocol for APIs. I think once there is some kind of agreement amongst stakeholders here in Qatar, and it's presented to, let's say, MOTC, the Ministry of Transport and Communication, as being the overseer of that technical standard, you will get a more positive and welcoming response. Whereas if the responsibility is put on the ministry to take the lead, there are other priorities in the jurisdiction apart from developing an API standard for open banking, which will take precedence, I think. So industry, I think you'll get a very positive response from an industry-led approach.
Thank you.
Thank you very much for your question and answers. Other questions or comments? So I have a question to Professor Arner, if you allow me to ask. You mentioned different approaches to data, so it was quite informative for me, and it was quite analytical. And given that Qatar is on the edge, I would say on the edge of introducing of open banking regulation, which approach to data would you suggest to apply in its regulations?
Yeah, I mean, I think you've got to think about in terms of, and I don't know what sort of rules Qatar has around data, the sort of data framework generally. The majority of countries have a sort of EU-derived system. But at the same time, the majority of countries actually have systems that are more property-based, which allow transfer, but then with some sort of protection rights. Not that many have the GDPR focus, which is really on a rights-based approach. Most have some sort of property-based approach. I think for jurisdictions which have the technical capability to build the necessary infrastructure to make it work, I increasingly prefer the rights-based approach. It allows the reusing of data much more effectively than a property-based approach. And so if that is already the direction, then that indicates that in all likelihood, from the standpoint of use of financial data, it makes sense to include, to build on the sharing framework that is already embedded into that sort of rights-based approach to data. The second aspect is really around jurisdiction size. So in other words, if you're a big jurisdiction, if you're the US, if you're China, if you're India, if you're Indonesia, if you're Pakistan, if you're Nigeria, where you have hundreds of millions of people, then you have the possibility of having enough data to be competitive against what I classify as other data majors. If you're not one of these, you don't have the possibility of actually competing with them. And it probably makes sense to build a system which then allows you to integrate on a more sharing basis with the increasing range of jurisdictions that have that rights and sharing based approach.
Thank you very much, Professor Arner. So any other questions from the participants?
I think Charles had a question or a comment. Charles, did you want to say something?
Yeah, it was just about the sort of distribution of data, just on the back of what Andrew was saying. I mean, Andrew knows me, I'm a builder, right? I'm not an academic and I'm not a sort of real consultant, but I'm looking at practical ways of actually implementing things. And I think that Qatar needs a central platform for that secure distribution and APIs, the interfaces for other people to be able to attach the different services to. So there's the sort of problem. You need some sort of central body and some compliance capability, and it sort of integrates in with the old methods of integration in the banking sector with the SWIFT transfers and other components like that. So I think we need a problem with data is that it's everybody's different version of the data. So if everybody's providing all these data stores and AI capabilities and the interfaces, then it's a very slow approach, right? So I think we need it.
Charles, you've been looking at like a blockchain solutions to these problems.
Yeah.
Like what's the response been in Qatar with the stakeholders you've spoken to?
You were talking to me?
Yeah.
Yeah. I mean, it was slow because they were getting confused between blockchain and cryptocurrency. So
Okay.
this is the problem, but the sort of world has rotated a couple of times since then anyway. And I think it's worth another move. There's a company out of the Ukraine, which has actually got a big footprint in UAE now, also as well, and they've got a blockchain exchange capability, and we were thinking of building one. But I would just pick up their sort of universal blockchain capability and use it for documentation and financial records and other distribution. But it needs to be in conjunction with the central authorities here. It won't go. And you mentioned in the presentation about APIs and the importance of APIs. The problem in IT is you have to share all these APIs, right? I mean, so then anybody wants to do it, it has to get their API out on the customer side and out on the banking side. So you really need a secure API platform, something like MuleSoft or Apogee, but built with something like that, or open source TYK, to actually consolidate all those APIs so that people only need to push it to the platform. They don't have to do both ends. It's not a one-to-many situation. It's a sort of a one-to-one situation between the customer or the provider and the platform.
Thanks a lot.
Thank you very much for your questions, and I want to thank all speakers and participants for participating in our today's seminar. It was quite interesting discussion, and I hope all participants learned something new about the open banking. And as our time has already finished, so I want to wrap up our session. So thank you very much for everyone.
Yeah, thank you, Doug. Thank you, Ross, and all the participants. A recording has been made, and we will share the link to that in due course. So thanks a lot.
Thank you.
Thank you. Bye-bye.
Thank you.
Bye-bye.
Bye-bye. Bye-bye.